Hello there, I'm Dr. Stock, Doctor of Education, and in this video we're taking a look at what I think that it's going to take for the markets to move out of its somewhat sideways trading action. What is the market holding its breath for? And honestly, I think there's pretty much a really simple answer here that really goes off in a myriad of directions. So I do want to get right into it to keep this video short for you. 2 days, just over 2 days till the Federal Reserve lets us know their vote. Are they going to raise the federal funds rate by another 25 basis points, or are they going to pause here? Well, we can take a look at the CME FedWatch tool, and we'll also take a look at the economic calendar. We'll also look at the markets and also have a spreadsheet for you for the CPI that comes out on Tuesday at 8:30 a.m., which I think is going to be a major component, a major vote, if you will, for whether or not the Federal Reserve goes ahead with that rate hike or if they pause here. And I think that we have a fair amount of evidence that will let us know which way they'll be influenced based on what we see from that CPI. So let me scroll down on this and check it out. You can see, as of the recording this video, there's almost a 3/4 chance that the Federal Reserve keeps the federal funds rate at between 5 and 5.25%, and that there's about a 25% chance that we're going to see, or 1 out of 4 chance that we see the Fed keep or raise the federal funds rate by 25 basis points. And that's just for the month of June. We can actually bump this up to the month of July as well to see what exactly we think is going to happen there. So there we go, click on July. And up at the top of this is the current rate. So you can see that as of right now, as we're recording this video, 5 to 525 basis points. And so just divide that by 100. That tells you about the percentage that you're seeing for the federal funds rate. Just in case you were curious about that, that basis points is in hundredths of a percent. So when we look at that for July, it's actually more than likely, as per the bond market, that we have half a chance for a 25 BP raise. And I think that this is going to change significantly after getting the CPI, but then there's also PPI. We also have consumer expectations. I think that this is going to change a lot between now and Wednesday. I think Tuesday with CPI is going to influence that heavily. So that's the most definitely something that we want to watch out for. So you can see here on the Federal Reserve's website, June 13th and 14th is the date of that meeting. That's tomorrow. That's Tuesday and Wednesday of this week. And that little asterisk is important because that also tells us about the summary of economic projections that we can expect from the Fed as well with their meeting. And I believe that comes out at about 2 p.m. So we can check that out on the calendar as well. So let's go right over to the calendar. And you can see here on Monday, 11 a.m. today, which this recording is about an hour and a half. It's about 9:30 right now. So the market has just opened. Consumer inflation expectations, 4.4% was previous, and we'll see what that updates to. I do want to say that if that 4.4% goes up, that could be more pressure on the Fed to keep raising rates in June. So that would make it a greater likelihood stays the same, probably not too much of an influence. If anything, a little bit more pressure for that 25 basis point hike. If that drops, that is less pressure. That is pressure taken off the Fed. The inflation expectations, consumer inflation expectations, dropping is a very good thing in order to influence the Fed to pause. So we most definitely want to watch that consumer inflation expectations, and we'll see how that influences the market. If that comes in lower, I think at 11 a.m. you're really going to see the market start to rally in a big way. So that could be one thing that moves us up a little bit out of it. I think CPI is the bigger thing that we're holding our breath for. And so the inflation expectations, consensus 0.2%, as we have on Trading Economics here, 8:30 a.m. tomorrow. And then 0.3% is what they're forecasting on Trading Economics themselves. And then for core inflation, and this is one that I really want to focus on, and I'll show you from the St. Louis Fed, something that I think is very important to watch for. So that 0.4% month over month that we have, and again, the forecast 0.3. So before we get to the spreadsheet that I have for you and talking about how I really think that what we need to see is going to influence the markets, right here, this is from the St. Louis Fed. There we go. Federal Reserve Bank of St. Louis. And you look at what we had prior to the pandemic. So this is all leading up to it. And you can see the 2008 financial crisis, and inflation didn't really change for us as per the core CPI. So this is CPI less food and energy. You can see the pandemic drop us down, and that was kind of like a spring that kind of, where we have that dampening constant. So for those of you out there who are into differential equations, it's been a long time since I've done that. I kind of miss it. But look what we've been doing. We've been narrowing all the way back, I think, since January of 2021, where we rocketed up past that. And these are month over month numbers that we're looking at. And so these are all percentages as well. You can see the percent change over here from one month to the next. April it shot up, and then you can see we kind of narrowed down on that. So what we're seeing is a pattern or a trend that's happening over time with the CPI, with these core CPI measures. Dropping down on this, like I said, is going to take pressure away from the Fed to raise the rates further. And so we most definitely want to be watching for that, and that's going to be good for the markets, in my opinion. And if we stay on trend, it's not that influential. If anything, it does still continue to take pressure off the Fed. Lower would be better. The same, well, it still puts us about where we're at. I still think we possibly get that pause in June as per the bond market. If we break this trend and go higher, I think that's where that real trouble comes in for the CPI. So breaking the trend higher from where we're at right now. So if we come in at a solid 0.5, not necessarily something that rounds to 0.5. So as a matter of fact, where I have my cursor right now is 0.45% month over month. So that does round to 0.5%. If we come in up above that, where we start to come up above, if we can imagine a trend line coming right across these points right up here and going up above that and breaking that trend, I think that that could be something that would be heavily handed for influencing the Fed to possibly put in that 25 basis point hike early. So we'll see if we get that from the CPI. As of right now, it's not something that's expected. It is expected to come in the same or lower. So we most definitely want to. Well, I just lost one of my studio lights, so you'll notice the lighting changed. Actually, maybe if I even like this a little bit more, but I'm going to go on without it. So if we do come in lower, that's a good thing. Takes pressure off the Fed, and we do expect the same or lower to come out. And that is something that if we continue to see confirming either steady but steadily lower even inflation, that is something, like I said, takes pressure off the Fed, and then the market gets to enjoy the sweet returns that come along with that. And then I think that we have maybe a little bit more of a run up. I think that there is a small correction due in our future, especially where the Qs are involved, that it is something we return back closer to the 50-day, although I think that we stay above it. And I think that we stay on the bullish trend for a bit longer. And that's something that I was surprised to see, but is definitely taking place right now. So with that said, I do want to jump over to Moomoo. And with Moomoo, just so you know, here, by clicking the link down in the description, you get up to 17 free stocks. So there is a link down in the description of this video. If you want to support this channel and the work that I do here, please find that link, sign up, and get your free stocks. And there's information you can find. I'll put it up here. You can pause the video. You can read more about it. But I do want to get over to Moomoo itself so you can see that taking place. So let's transition. Oh, I'm sorry, I forgot about the spreadsheet. Yeah, we'll get to the spreadsheet in a moment. I like looking at the charts. We'll look at the charts. So here we're looking at the S&P right now, and you can see it's been on a decent run going all the way back to October of last year. And we've kind of slowed down a little bit, stagnated a little bit, but we are continuing to stay above the 200-day, which is bullish, above the 50-day, which is bullish. We do have a fair amount of separation between the 50 and the 200-day. So we want to see that 200-day, and I think that you can just barely start to see the tail of this start to inflect upwards, which is a good thing. So we have more confirmation that we're going to continue on a bull run for a bit longer. So we'll see what exactly happens with the markets along there. And let's go over to the Qs, because that's the one I'm really interested in for CPI, because I think that this is going to be the most reactive. So with the Qs, you can see the sharp uptick that we've taken recently for QQQ, and we've plateaued right at about $356, $357, right around there, that we can't really seem to break out of it. And every time we try, we get these doji candles that kind of show a lot of indecision between the bulls and the bears. Like, what exactly is going to happen to the market? I don't know if we should keep trading, keep counting on it going up. Look at the long-term trend that we have. Anytime that we start to take off in that parabolic nature, and the importance here is that we have is a concave up movement, which indicates a faster rate of increase. It is something that eventually starts turning on us, and we start to have more of a concave down, which there should be a little bit of a leveling off, and that would be something healthy for the markets. I do want the rally to continue. However, having those big shocks is something, the volatility is something hard on our emotions, and we want something that keeps us cool-headed as much as we can be. However, we have a decent looking chart forming up here. The momentum is good right now. If you actually look and see the momentum staying up above the 50 on the RSI, most times that's good for bullish behavior. Whereas when you look at this big sell-off, most times we barely spend any time whatsoever above 50 on the RSI. So anytime that we came up, we came right back down, and then we spent some time down below trend. So we do want to watch and see for that. If we do dip down below this, that we start to go into bearish territory, that it is possible that's a buying opportunity. It sends us right back up again, especially if this is continues to be bull market, rally on, and that's absolutely something that I'm watching, paying attention to, and taking advantage of. By the way, Tesla, if you haven't seen it, over in the Patreon and in the private Discord I mentioned about Tesla being up over its 200-day, that's a good thing. It hadn't happened since I think September of the previous year, and this is something that we could possibly have that golden cross moment. This isn't a video on Tesla, but definitely worth something checking out. So as for the CPI though, the CPI I think is what breaks us out of this little movement that we have here that's going to decide if we get that drop off, if we get something we didn't expect, especially to the upside, would be something that we want to watch. If we get exactly what we expect, I think we have a sell the news event. If we get something that's to the downside on inflation from the CPI, that's something I think allows us a little bit more of a pop before we start to see that correction taking place sometime in the near future. So we're going to have to watch that and see what direction the market decides to take. That said, I want to get over to the Excel spreadsheet. So let me pop that up there for you. So this is a spreadsheet that I've made from the data from the St. Louis Fed on the CPI. And what we're looking at here in yellow, this is May, and there's a little asterisk up here that shows that anytime that you see that, those are all estimated values. So think about this more as a projection more so than an estimate that you would see. So these numbers are actual numbers then based on the percentage that you see. So if we get 0.2% month over month, that brings us down to 4% year over year for May. And so I think that would be, seeing that 4% even would be incredible. If we watch that go down into the threes, I think that we see the market react strongly to the upside. So I think that this is something, sell the news happens if we get something fairly low, considering that we were up near 5% last time, 4.9%. Dropping down to the low fours from there is going to be astounding no matter what. That's going to be an excellent headline number to watch out. I'm almost certain of it. However, if we see anything below what we currently expect, below that 0.2, if we get 0.1, we are down to, I don't know if you can see that or not. There we go. If we get down below 0.2%, we have 3.9% year over year. So down into the threes where we're up at almost 5 the last time, we would be, and yes, I know 3.9 is almost 4, but still it's in the threes. And I think that would have a huge impact on the market to the upside. I think that'd be a lot of excitement over the headline number. By the way, look at these June numbers that we have here. Let me zoom back out so you can see them a little bit more. There we go. So June, depending on what we get for those month over month, year over year. So that if we get 0.2% this month and next month, that puts us down. We go from 4 or nearly 4 down to possibly the 2s when we get June's numbers in July. I think that there's a lot to be excited about. Now, when we look after that, it'll be a little bit rough to try and stay in the 2s. However, being down in the 2s when we were just at 5% a few short months ago and near 5%, and now we're down in the 2s, so down in possibly the 3s this month, down in possibly the 2s the next month. I think there's a lot of reason why people are excited. So if inflation, as per the CPI, really starts to put out these numbers, these extremely low numbers, which could possibly happen, that can be exciting. Now let's go over to core. So when we look at the core numbers, now we're actually sticking up a little bit higher. So 0.3% is what we have for the forecast. 0.4% is also forecasted in there, whether it's Wall Street or whether it's trading economics. And you can see that puts in at 5.3 or 5.2%. And again, you can look at June's numbers where we can possibly finally break down out of the 5s. And so we might see a little bit more of that stickiness happen here. However, I think that being that we're in bullish territory right now in the markets, I think people, core or not, when we look at CPI for all items, the not core numbers, dropping down to the 3s would be incredible. Staying in the 4s would be okay. And here, we would have to have something pretty incredible drop us down to the 4s. We would have to come in even month over month to actually drop down to the 4s as per core. Much easier, though, when we get June's numbers when July comes out. So we're going to have to watch that. It is possible we get another very strong quarter coming out of this, that we wrap up quarter 2 of 2023 on a high note. And then I think there's going to be a bit of volatility as we get into the end of June, by the way. I think that there's going to be a lot of people capitalizing on the profits, institutions, hedge funds, moving into just different positions, moving money around, locking in their profits, and then finding cheaper areas in the markets. And we may have already started to see some of that rotation already, such as moving into energy stocks, moving forward from where we're at. So let me wrap this thing up for you. So as per the CPI, I think the CPI is going to be something that comes in as expected or lower. I don't expect it to come in higher. I think the markets, if we come in as expected, are probably going to sell off a little bit. If they come in lower than expected, I think that's going to allow the markets to rally just a little bit longer off those numbers. PPI is certainly something that can help that out. That comes out Wednesday at 8:30 a.m. And I believe that this Friday is also where we get the consumer sentiment from the University of Michigan. So this week could see a lot of volatility, and I think the CPI is going to set the tone for that, whether it's going to send us up a little bit further or if it's going to start that tailspin downward, and we're just going to have to see if we get those mixed signals from the different metrics that we have out there, or if it's something that's going to really give us a clear and consistent message that not only does the consumer feel as though inflation is being stamped out, but that the CPI and PPI also confirm that inflation is also going to be stamped out. Because if we get that confluence across those metrics, that can help the market continue to rally and take that bullish looking flag that we have and allow it to play out in a bullish manner. If we get mixed signals, we can get mixed markets. If we get clearly consistent signals that inflation is higher and the consumers expect inflation to be higher and consumer sentiment comes out lower, then that is something that can really cause the market to sell off and possibly retest its 50-day. And we'll see where that lands. I am pretty hopeful in the near term that we see that moving to the upside. Thank you guys for watching this video. Check out that link for Moo down in the description. Like I said, you're supporting this channel, but you're also helping yourself in that. Plus, there's a $100 cash coupon in there. It's an incredible opportunity and incredible platform. I use it in my videos. I also have my personal account over there as well. So go ahead and check that out. Also, there's a link for the Patreon down in the description. Don't forget about checking that out as well. If you like this video, like it, hit the subscribe button, and ring that notification bell to see anytime that my videos come out. I am Dr. Stock, Doctor of Education. We'll see you in the next video.